Ever wondered why a dollar in the US isn't worth the same as a euro in Europe or a yen in Japan? The value of currencies isn't based on one simple factor, and the differences go much deeper than just supply and demand. Let's break down why currencies around the world have such varied values and what influences them. Currency is an essential part of the global economy. It helps people buy goods and services, businesses trade internationally, and governments operate efficiently. However, not all currencies are created equal. Different currencies carry different values, and that difference affects everything from the price of imported goods to a traveler's experience abroad. So what factors determine why currencies vary in value? Number 1. Economic stability and strength. A strong economy often leads to a strong currency. When a country's economy is growing, with low unemployment and high consumer confidence, its currency tends to increase in value. Strong economies have stable governments, low inflation, and a healthy financial system. For instance, the US dollar, backed by the world's largest economy, has a higher value compared to the currencies of smaller economies with less stability. Governments and central banks play a role in managing a nation's currency value. They use tools like interest rates to influence inflation and economic activity. A country with a stable economy will generally see less fluctuation in the value of its currency compared to one experiencing high inflation or economic instability. Number 2. Inflation rates. Inflation has a direct impact on the value of a currency. High inflation erodes the purchasing power of money, which lowers a currency's value. For example, if a country has high inflation, its currency's purchasing power will decline, and it will require more units of that currency to buy the same goods and services. In contrast, countries with low and stable inflation rates tend to have stronger currencies. This is why the Swiss franc, with Switzerland's history of low inflation, is often considered a stable and strong currency. Number 3. Interest rates and central bank policies. Interest rates are another major factor influencing currency values. Higher interest rates typically attract more foreign investment, which increases demand for a country's currency. This is because investors seek to earn higher returns on their investments. As demand for the currency rises, so does its value. Central banks use interest rates to control inflation and stabilize the economy. When a central bank raises rates, it signals confidence in the economy, attracting foreign investors and pushing up the currency's value. On the other hand, if the central bank lowers rates, it can lead to a decrease in currency value as investors look elsewhere for better returns. Number 4. Political stability and governance. Countries that have strong political institutions and stable governance tend to have stronger currencies. Political instability, corruption, and poor governance can lead to economic uncertainty, which weakens a country's currency. Investors typically avoid countries with unstable political environments because there's a higher risk involved. For example, when a country faces political turmoil, like a coup or a national crisis, the currency often loses value due to investor fear and lack of confidence. Conversely, nations with stable governments attract foreign investments, boosting demand for their currency and increasing its value. Number 5. International trade and export demand. The balance of trade, which is the difference between a country's exports and imports, plays a crucial role in determining currency value. A country that exports more than it imports will see its currency strengthen. This is because when foreign buyers purchase goods from that country, they need to exchange their currency for the country's currency. This creates demand, pushing up the currency's value. On the other hand, countries with a trade deficit, meaning they import more than they export, will likely see their currency depreciate. This is because more of their currency is being exchanged for foreign currencies to pay for imports, decreasing its value. Number 6. Speculation and market sentiment. Currency values can also be influenced by market speculation and investor sentiment. If investors believe a country's economy will perform well in the future, they are likely to buy its currency, increasing its value. Conversely, if they expect economic problems or instability, they might sell off that country's currency, causing it to lose value. Speculation often causes fluctuations in currency values in the short term. For example, political events, such as elections or changes in government policy, can lead to uncertainty. This uncertainty can prompt investors to adjust their portfolios, buying or selling currencies based on their expectations of how the event will impact the economy. Number 7. Global events and natural disasters. Global events such as natural disasters, pandemics, or geopolitical conflicts can dramatically impact currency values. These events often lead to increased uncertainty in the markets. For instance, during the COVID-19 pandemic, many currencies saw fluctuations as investors reacted to the changing global economic situation. Countries with stronger healthcare systems and more resilient economies often saw their currencies hold value better than others. Similarly, natural disasters, like earthquakes or hurricanes, can disrupt a country's economy and decrease confidence in its currency. If a country experiences a major disaster, its currency might depreciate as investors move their money to safer assets. Number 8. Commodity prices and resource-based economies. Some countries' currencies are heavily influenced by the prices of commodities. For example, oil-producing countries like Canada or Russia rely on the price of oil to support their economies. When oil prices are high, the value of the currency in these countries tends to rise because of the increased demand for their key exports. On the other hand, when commodity prices fall, the currency value of these nations often declines. Resource-based economies are more vulnerable to global fluctuations in commodity prices. A sudden drop in the price of a key resource can lead to a significant depreciation in the currency's value. Number 9. The role of reserve currencies. Some currencies, like the US dollar and the euro, serve as reserve currencies. These are held by foreign governments and financial institutions as part of their foreign exchange reserves. The US dollar is the most widely held reserve currency, and this gives it an advantage in terms of demand and stability. Countries that hold large reserves of these currencies may be less susceptible to sudden fluctuations in value, as the global economy relies on them for trade and finance. The widespread use of reserve currencies increases their value, as countries and institutions around the world need to hold these currencies to facilitate international transactions. This demand helps keep the value of reserve currencies higher than that of others. Number 10. Exchange rate mechanisms. The way a currency is valued also depends on the exchange rate system used by a country. Some countries use a floating exchange rate, where the currency's value is determined by market forces of supply and demand. Others, like China, may use a managed or pegged exchange rate, where the government actively intervenes to maintain a specific value for the currency. Floating exchange rates are more volatile since they fluctuate with market conditions. Peg exchange rates tend to provide more stability, but they require significant reserves and government intervention to maintain. 11. Foreign exchange market. The foreign exchange market, Forex, plays a major role in determining currency values. This market is where currencies are bought and sold, with the value of a currency determined by supply and demand dynamics. The Forex market is the largest and most liquid financial market in the world, with over $6 trillion in daily trading volume. Currencies that are heavily traded, like the US dollar, euro, and Japanese yen, typically have higher liquidity and stability. Less traded currencies tend to be more volatile, as small shifts in demand can cause significant fluctuations in their value. Currency values are shaped by a complex mix of factors, from economic strength and political stability to market speculation and global events. Understanding these factors helps explain why currencies fluctuate and why some are stronger than others. Whether you're a traveler, investor, or just someone curious about global finance, knowing the reasons behind currency values gives a clearer picture of how the world's economies interact. If you found this explanation helpful, don't forget to like, comment, and subscribe to our channel for more insightful content.